Good morning, everyone. Today, I just wanted to talk a little bit about something that I think it was two parts to this video. But the first part is what's going on in kind of like the over global economic with the war with Russia and Ukraine, and not really my thoughts morally or whatever. Obviously, I mean, I think it's wrong. I think what's happening in that part of the country or that part of the world right now is terrible. Like, it's 2022. I mean, there's just no words anyway. But I mean, on the overall global economy and why the stock market went last night from like down, oh gosh, it was tumbling, to finishing up on the day. As many of you may know who follow stocks, that the S&P 500, the NASDAQ, all those guys were big turnaround. NASDAQ had almost a 900 point swing from the bottom to the top of its 1 day range, which is insane for a huge industry to move that much. I mean, for stock, yeah, earnings come out and that the stock could go down, a couple standard deviations. That's it happens, but not the index. So basically what happens, and the reason I'm putting this out there is because my wife kind of asked me, like, you're in finance, what does it mean? And I'll kind of break it down into what I'm pretty sure happens to what I am more sure happens. So I'm pretty sure what happens is that when there is a lot of war, people are afraid. When there's uncertainty, right? There's a chart that you can ask me for in the comments of that. When war breaks out, stock market goes down, and then ultimately it goes up, even though the war isn't even over yet. Because stock market cares more about the fact that there is war and the announcement of that than they are in the actual ramifications and operational happening of the war. They're more afraid of the unknown. So people were afraid, and that's common. That spike of selling is normal fear in the market. And VIX went up a little bit, which is the fear index. And then when we kind of knew what was the situation, so to speak, then we started getting more comfortable, and we realized that while it's terrible what's going on there, the way that the market is priced, actually we oversold, or we actually thought the impact, when we kind of realized that the global impact of what's going on in the Russian-Ukraine war, the economic impact to the actual U.S. markets is relatively nil. I mean, yeah, it sucks. We may have to send some soldiers overseas. There's lots of, where I live in Texas, there's a lot of families whose spouses or family members are getting, ready for deployment, which is sad. They lose time with their families, and they're put in an unknown situation where they could lose their lives. So it's not by any means a good circumstance, but what it kind of goes to show us that the impact financially on U.S. financial markets is not really there. So that's why I'm pretty sure nothing's happened. And today the market's pretty much unchanged. It bounces, up and down a little bit. Sometimes it's up 100, sometimes it's down 100. It's just normal trading. The reason I'm pretty sure, or more sure, that the selling happened and rebalancing, and there's a ton of movement, is because when you're an asset manager, all these mutual funds, hedge funds, etc., you have to make moves. And if something like this doesn't make you make a move, then why is anyone hiring you to do anything? Because everybody can see that war is not good. I used to be in asset management, more on the retail side, so I wouldn't do any of the actual buying and selling of portfolio things. But I mean, these are the questions that we would ask the fund managers, right? On behalf of our clients, we say, well, what did the fund do during the Russian-Ukraine war to reposition itself so that the assets would be better protected against these geopolitical risks, right? And the asset manager can't just be like, well, nothing, because we know that if we just stayed invested in the market, we would come out at least on par, right, with where we were. A lot of asset managers right now, they reallocated their risk metrics, kind of got out of whack, and then maybe they hit some of their stop losses, they lost it, and then now the market's 3% higher than where they sold it, and they got to buy back in because that's their mandate to keep all their assets invested, right? That's primary, because if not, what are we paying you for, right? If you're going to invest our money in cash, I can do that easily. Just pop it in the bank and lose 7% of its purchasing power every year. Why not, right? So that's kind of why I think that happens. I mean, it's not a very popular response, I'll be honest. Like, the reason, the as a person who's in and out of the markets, believes that the main reason why the market kind of did what it did was because of keeping the customer happy. Ultimately, nothing really changes, though. Market goes up a little bit, market goes down a little bit, market goes down a whole lot, market goes up a whole lot. All that we know is, historically speaking, the market does return a positive, or at least an inflation beating return year after year. Time periods can make things look great and look terrible. I was thinking about this the other day, actually yesterday, when I was baking cornbread, that the market goes up. It's like a slow grind up, right? But if you take the short side, meaning you think that the US economy is going down, you would have been painfully wrong a lot of time. And most people can't remain that wrong for that long because they'll run out of capital, right? In order to stay short, I mean, you're gonna have to pay it back sometime, and these brokerages aren't gonna, keep your negative $10 million balance when you have no collateral or no way to pay it back, right? You just can't do that. But it's important for short sellers to exist, because when the market does crash and everyone is selling, they're the only people buying, because they're buying back their position. So for short sellers, their market balance, or they keep the market in balance, not imbalanced, in balance with each other, because when things start to get overly sold, they start to catch on, they start to cover, meaning that they're saying, yeah, the stock was overvalued over here at $300, but at $150, yeah, I'm not gonna hold this thing any longer. Like, I can't hold this short position any longer, because $150, that to me is fair value. We're selling. Whereas a lot of people who are long, all they know is that their thesis is wrong. This stock is no longer worth $300, and I should have sold a long time ago. So they're just trying to exit the position, period. So it does add a lot of market stability by having short sellers. Now, it's really hard to be a short seller. Imagine if, instead of looking at the graph showing that the S&P 500, 7 to 10% per annum, inflation adjusted maybe, right? You're looking at negative 7 to 10% per year, plus the inflationary, plus the cost of being short, which is you're borrowing stock. So you're essentially loaning out, or you're borrowing money to sell stock, because you're short the position. So you need the cash, or you need to borrow. So you're in a lose-lose situation. So short sellers and perma bears, they got a lot stacked against them. So their conviction has to be really strong. So you know, don't think about these perma bears or these people who are bearish on the stock market as terrible people. They're just part of the market. They need to be there in order to create the floor, right? Buy back the positions when they feel is oversold. And they also need to be there because a lot of times we can't all just be buying, because then there's nobody that's going to be selling, right? If it's a great buy, why would anybody sell it? These people are thinking, yeah, up here at $300, I will sell this all day. And those, they add to market liquidity, which is my next video. So stay tuned for market liquidity and why I just realized that trading out of the money options is way easier than trading in the money options.